Welcome to this Killick Explains video, and whilst I don't want to stray onto Rachel, my colleague's turf, I would like to use why bank shares are so beaten up, or should they be so beaten up, as a way of getting into a few educational pointers. So the topic is banking shares. Why are they so beaten up? I'm not going to give you a view on whether you should buy or sell them. That's for other people to do if you like, but I am going to use it to just make a few points that I think are relevant. So let's look at the three types of banks so far. When we say what are bank shares, are bank shares beaten up, have they been oversold and so on, what do we actually mean? Well, arguably there are three main types of bank. You've got retail stroke commercial banks. Broadly speaking, these are people that take deposits from individuals and companies, if you like, and make loans, whether those are mortgages, whether those are commercial loans and so on. Fairly straightforward type of business. Then you've got the investment banks. They don't tend to do that. They're much more involved in mergers and acquisitions, underwriting, advisory activities, so high risk, high profits if you like. And then you've got the universal banks, as I broadly call them, which do both. And banking as a sector covers all three types: pure retail commercial, investment banking, pure investment banking, and the ones that I've called universal that do the two types. Now, what's going wrong taking those in turn? Well, if you look at classic retail activities or commercial activities, if you like, because the stock market has been struggling and the bond market has been struggling as well, securities carried by banks on their books as assets have been marked down, and that's had an effect on their profitability. There's less underwriting activity going on as fewer companies come to market and so on, and that reduces the fees available there. And there is unquestionably this hidden nasty out there of growing credit risk. In other words, banks are trying to work out how many individual consumers might start to struggle paying off personal loans, mortgages, as interest rates rise. How many corporate clients, companies might hit problems repaying loans and so on as costs rise, wages rise, and interest rates rise, making debt more expensive. So what about the investment banking side? Well, here banks are not having such a good time either, because there's much less merger and acquisition activity. When stock markets are a bit wobbly, a bit volatile, a bit more uncertain, less easy to predict, you get fewer companies trying to buy other companies. I mean, just look at summer of 2022, Elon Musk pulling away from buying Twitter, for example, classic case in point. There are fewer IPOs, special purpose acquisition vehicles, SPACs as they're known, have pretty much died off. Those were bull market, frothy market sort of constructions, if you like. And trading is tougher. As Warren Buffett said, when the tide goes out, you find out who's been swimming naked. What he meant by that is the banks have proprietary trading desks, making money on those desks, not impossible by any stretch. I mean, hedge funds manage it, but it's tougher, all right? And then there's something that affects banks of all sorts, and that's operational gearing. And that is the fact that many banks have a high fixed to variable cost or total cost ratio. Why? Because if you look at a bank, literally look at a bank, it's got lots of buildings in expensive places, whether that's Canary Wharf, New York, in the middle of cities and so on. And staff costs tend to be a significant proportion of their cost base, and staff costs are sort of sticky in the sense that you can get rid of staff, but you sort of have to chunk down through your cost base, and getting rid of them is expensive anyway in a lot of cases. So this gives them what's called high operational gearing. It makes profits volatile because when sales and turnover rise, profits tend to rise disproportionately. You get super profits, but equally when turnover and sales fall, profits tend to plummet. All right? So this model, this operating model, tends to lead to volatility in profits when markets themselves are volatile. Now, so far you might be thinking, and these are all reasons to steer well clear of banks. Who would buy bank shares? And I'm not tipping bank shares in my video, it's not my job, but there is a flip side. I want to use this to just say, well, there are people out there saying, hang on a minute, Tim, it's not all doom and gloom. So what are those flip sides? Number one, banking is one of those must-have activities. These days, you can't do without water, electricity, and so on, heating. And equally, it's pretty difficult to exist without banking. It's a kind of must-have. And as such, there's always going to be a market for what banks do, and that's not true of other companies. Balance sheets are relatively strong because of the financial crisis and so on that happened a while back. Banks have had to reinforce their balance sheets. A lot of them carry a lot of cash. A lot of them don't know what to do with that cash. As I mentioned earlier, the M&A activities dried up and so on. A lot of them are carrying cash, and that makes them relatively solid as investments, if you like. Rising interest rates can help, okay? And the reason for that is that as interest rates rise, it tends to stretch the gap between what banks charge people to borrow money and what they offer people to deposit it with them. So that margin expansion is good for banks in a rising interest rate environment. And deglobalization will create as many opportunities as it creates threats for the classic standard banks. Okay? Operational gearing can work in reverse. And what I mean by that is, yes, operational gearing, high fixed costs are pushing profits down in volatile markets, but should we get some sort of recovery, banks are in a position potentially to lead the charge on profits and earnings. And some would say, if you look at share prices, if you look at P ratios on banks, they're all priced for a pretty bad recession already, as analysts and so on worry about hidden credit risk. All right. In other words, we've already got to tin hat time, hands on heads and so on. And actually, should the economy prove to be a bit more robust than is currently thought, banks will be in a position to pull out the other side. Now, which side of the argument you stand on comes down to you. I'm not about to tell you which side you should be on, but I just wanted to use this video to highlight some of the problems facing banks at the moment and the reason why their shares have been beaten up, but equally some of the flip side arguments. And that's an important skill in investing, is to be able to work out where the balance of those arguments lies. So, lots of technical jargon there. If you'd like to watch videos on banks in particular and other things, then killick.com/learn is our video library. If you'd like to read about equity investing, I have a guide, How to Invest in Equities. Not a very imaginative title, you might say, but it's available, editor@killick.com. And if you'd like to read about sectors, including banking, with a bit more sort of a research commercial flavour around it, if you like, then this thing, Confidant, is also available, editor@killick.com.